Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Multisensor AI.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah.
So I want you to imagine an automotive assembly line for a second.
Okay, yeah.
Just picture these massive synchronized robotic arms, right? They're pumping out a brand new $60,000 truck literally every 60 seconds.
It's incredible to watch, honestly.
It is. It's a total marvel of modern engineering. But then deep inside this central conveyor belt, there's this tiny $50 bearing, and it just seizes up.
Oh, wow.
Yeah, it overheats, it cracks, and suddenly that entire mile-long assembly line just grinds to a devastating halt. The whole factory floor just goes dead silent.
Which is the absolute worst sound for a plant manager to hear.
Exactly. Because when that happens, it's not just, a minor inconvenience. That is literally $1 million an hour going up in smoke.
Right. Just evaporate.
Right. While a maintenance crew is literally scrambling around with flashlights and toolboxes trying to find the problem. So today, we're looking at a company whose entire existence is dedicated to making sure that scenario never, ever happens again.
Yeah, and it's such a massive transformation story playing out in the market right now.
It really is. I mean, we're talking about a company with a 30-year heritage as a total pioneer in industrial hardware. But now they're attempting this highly ambitious pivot into an AI-driven recurring revenue software platform.
And that transition, moving from that legacy hardware-centric model over to a nimble, high-margin software model, that is where the real wealth-building opportunity lies for you as an investor right now.
Right, because the stakes are just so high.
Exactly. If you look at the macro environment for these asset-intensive industries today, the pressure is immense. We're talking about global logistics hubs, hyperscale data centers that are basically powering the entire cloud, and heavy manufacturing plants.
Yeah, where unplanned downtime is it's the ultimate enemy of profitability.
It bleeds capital, and Multisensor AI operates right at the bleeding edge of this predictive maintenance market.
Right.
Their value proposition, it's no longer just, selling a camera. It's about deploying this invisible, intelligent safety net, one that actually predicts and prevents catastrophic equipment failure before the very first spark even flies.
Yeah, and to really understand how this shift impacts your portfolio, we have to look closely at what they actually do on that factory floor, right? And how their tech has evolved.
Definitely.
Because for over 3 decades, they have been engineering these world-class sensors. And we're not talking about off-the-shelf consumer tech here.
Oh, not at all, no.
Right. We are talking industrial-grade thermal imaging, stuff that can detect microscopic heat friction inside a completely sealed motor.
Yeah, plus the high-definition visible cameras and the acoustic sensors.
The acoustic sensors are wild to me. They can literally hear a bearing starting to grind over the deafening noise of a massive factory.
It's honestly like giving the factory a central nervous system. They even use vibration monitors and laser spectroscopy.
Right, but here is the major catalyst for the SOC.
Yeah.
They recently launched their Connect 2.0 platform. And this is just a monumental shift for them.
It really is the turning point.
Because they're moving away from the old model. Right.
Yeah.
The one where they just sell a physical piece of hardware in a one-off transaction. Now they're moving entirely toward a hardware-agnostic, software-focused ecosystem.
Which, fundamentally, that changes the valuation multiple that Wall Street will eventually assign to them.
Exactly. Because the market, they value one-off hardware sales at a heavy discount.
Right, because you always have to be hunting for that next big contract. You eat what you kill every quarter.
Yeah, but recurring software subscriptions, those get the premium SaaS-like multiples.
Exactly. But the competitive moat they're building here is what truly stands out to me.
Tell me about that, because there are a lot of tech players out there.
Well, if you look across the whole predictive maintenance landscape, most competitors really just specialize in single sensor modalities.
Okay, like what?
You might have a great startup that does phenomenal vibration analysis, or maybe a legacy company that only does thermal imaging. But Multisensor AI's Connect 2.0 platform uses unified multi-sensor data.
Ah, so they bring it all together.
Right. They fuse all those different data streams together using their proprietary AI algorithms.
Let's break down why that fusion is so critical. Because to me, it seems like that is the absolute core of their technological moat.
It is. Without it, you just have noise.
Right, because a single sensor can easily lie to you.
Right.
If a vibration sensor on a massive industrial turbine alerts you that the machine is shaking, the plant manager might completely panic.
Understandably so.
But what if, a heavy forklift just drove past the sensor? That is a false positive.
Yeah, and if you shut down the plant based on that one forklift, you just wasted hundreds of thousands of dollars for literally no reason. But if that AI is fusing the data streams, the picture becomes definitive. If the turbine is vibrating and the thermal camera shows it is running 50 degrees hotter than its baseline,
Right.
and the acoustic sensor is picking up a high-frequency squeal, the AI knows with near certainty that a gear is failing.
It's all about the context.
Exactly. And crucially, multisensor AI backs up that algorithmic diagnosis with a layer of human validation.
Wait, really? Human validation?
Yeah. In these high-volume, safety-critical industrial environments, a false positive is incredibly costly, like we said. But a missed failure is catastrophic.
Right, someone could get hurt or the whole plant burns down.
Exactly. So having specialized human analysts actually review the AI's flagged anomalies before a shutdown order is issued,
Right.
that provides a massive psychological and financial safety net for these industrial clients.
I mean, it is a fascinating pivot. But honestly, I look at this 30-year hardware legacy, and while it's impressive, it makes me a bit nervous.
No.
Well, we are watching them try to transition from selling one-off hardware installations, which is kind of like selling CD-ROMs back in the 1990s, to managing a sticky, cloud-based software subscription.
Right. Moving to a SaaS model.
Yeah, and that is not just a billing change. That requires changing the entire DNA of a company.
It's a huge cultural shift.
You have to change the psychology of your whole sales team, right?
Huh?
Shifting them from hunting massive million-dollar hardware paydays to farming a steady monthly SaaS drip feed.
Which is notoriously difficult for legacy sales guys to do.
Exactly. Plus, with so many Silicon Valley giants just swimming in the AI space right now, what is stopping a massive software firm from just writing better, faster code to beat them?
It's a totally valid concern, and it really gets to the heart of why domain expertise matters so much in the industrial sector.
Right.
You cannot simply throw a team of brilliant Silicon Valley coders at a manufacturing problem and expect them to understand the thermal degradation curve of a high-pressure boiler.
That's a great point. They don't know the physics of it.
Exactly. You need decades of physical, real-world data to actually train that AI, and that is their moat.
The data itself.
Yes. The deep proprietary engineering intellectual property they have accumulated over 30 years of actually building the infrared and sensor hardware. It gives their software a massive, almost insurmountable head start.
Because a pure software company just lacks that physical world context.
Right. They don't have the training data. Multisensor AI's Connect platform is already proven across hundreds of global sites because it was built by people who have actually spent their careers in hard hats,
Right.
not just sitting in coding boot camps.
That makes total sense. The data is the moat. But, I mean, a brilliant AI platform and a deep moat are completely useless if plant managers won't actually sign the checks.
Very true.
The financial math driving the customer adoption has to make sense. And based on our market analysis here, the deployment economics for this platform are frankly staggering.
They really are.
Customers are seeing a complete payback on their investment in as little as 2 months.
2 months to recoup the initial capital expenditure. That's unheard of in industrial tech.
It's crazy. And when you zoom out to the long term, the math becomes even more compelling for you to consider as an investor. Over a 5-year period, customers are seeing up to an 8x return on investment.
Yeah. Think about what that actually means on the ground.
Right.
When an industrial plant manager walks into their CFO's office asking for budget approval, an 8x ROI with a 2-month payback isn't a tough sell.
No, not at all.
It's the kind of math that gets rubber-stamped instantly. Catching just one failing conveyor motor before it triggers a multi-day plant shutdown essentially pays for the entire multi-sensor AI ecosystem for the entire year.
And then some. Okay, but let me play devil's advocate for a second here.
Go for it.
An 8 times ROI and a 2-month payback sound almost too good to be true.
Right.
If the financial benefit is that obvious and immediate, shouldn't literally every heavy manufacturing plant, every logistics hub, and every single data center in the world already have this installed?
You would think so.
Yeah, like, why isn't their revenue already in the billions? What is the friction that's stopping universal adoption overnight?
Well, the friction lies in the sheer complexity of industrial enterprise sales.
Okay.
You are not just downloading an app on a smartphone here. You are dealing with massive, sprawling legacy infrastructures.
Right, these plants are huge.
And old. Upgrading a decades-old manufacturing plant's centralized monitoring architecture is a grueling process. It requires integrating with their existing SCADA systems, that's supervisory control and data acquisition, and their PLCs, or programmable logic controllers.
And some of those are ancient, right?
Exactly. Some of these PLCs might have been installed during the Clinton administration.
Wow.
Getting a modern cloud-based AI to securely communicate with legacy analog systems, it takes months of mapping data points and methodical integration. It is a slow, heavy-lift sales cycle.
But that exact friction is kind of a double-edged sword, isn't it?
How do you mean?
Because once they finally get through that agonizing integration process, they are deeply embedded in the plant's operations. The switching costs must be astronomical.
Precisely. The friction to get in creates the ultimate stickiness once they are actually operational.
Right.
Once the Connect 2.0 platform is fully integrated into the central nervous system of a multi-site operation, it becomes incredibly difficult, expensive, and just painful for the customer to rip it out.
Yeah, you aren't just canceling a software license to save a few bucks on the quarterly budget.
No, you would be blindly severing your plant's early warning system. You would literally be voluntarily walking back into the dark ages of reactive maintenance.
Which no plant manager wants to do.
Exactly. That deep integration creates a highly dependable, wildly sticky, recurring revenue stream. And Wall Street loves that.
Which perfectly explains why the market opportunity is so massive and why they need capital to scale rapidly before competitors catch up.
Right. They need to hire the specialized sales engineers to do those complex integrations.
And that brings us to their latest financial move, which is absolutely critical for you to understand if you are evaluating this stock right now.
It is the defining catalyst of the moment.
Right. So on March 13th, 2026, the company entered into an at-market sales agreement, an ATM, to offer and sell up to $60 million in common stock.
Yes, and the market reaction, or rather, the lack of a negative reaction, is very telling.
Yeah, that surprised me.
Right now, the sentiment surrounding this move is decidedly neutral to constructive. The stock is currently consolidating. It is not trading like a distressed asset at all.
No, it's holding up well.
When this $60 million ATM was announced, we did not see a wave of panic selling. Institutional interest remains highly active, and the stock actually continues to be highlighted in broader IT sector rotation movements.
Okay, so what does that tell us?
This tells us the institutional money views this capital raise not as a desperate lifeline just to keep the lights on, but as strategic dry powder.
I want to pause on that because it's crucial. Whenever a company announces they might issue $60 million in new stock, retail investors almost instinctively panic about dilution.
Oh, always. It's the knee-jerk reaction.
Depending on the company's market cap on any given day, we are talking about a potential 5 to 10% dilution to existing shareholders. That is a real bite out of your equity.
It is.
So why is the market giving them a pass here? Are they really just building a war chest, or are investors asleep at the wheel?
It is definitely a war chest. And you have to understand the mechanics of an ATM to see why the market isn't panicking.
Okay, break that down for us.
An at-market sales agreement isn't a massive block trade that hits the tape all at once and just crashes the bid price.
Right. It's not a sudden dump of shares.
No, it's a facility. It allows management to trickle shares into the open market gradually at prevailing prices, and they often do this on green days when volume is high.
So it absorbs the impact.
Exactly. It keeps dilution controlled and methodical. And more importantly, the market is focused on why they actually need that capital. This $60 million provides ultimate strategic flexibility.
Right. They're positioning themselves for potential mergers and acquisitions.
Yes, because they are moving to a hardware-agnostic platform now.
Yeah.
They don't just want to analyze data from their own cameras anymore. They want to ingest data from everything.
Okay, so acquiring complementary IoT software startups makes sense.
It makes perfect strategic sense right now, or even niche sensor manufacturers. It accelerates their market capture and buys them completely new customer bases to cross-sell into.
And I guess it also provides a robust buffer for debt reduction if the macro environment tightens up.
Exactly. Furthermore, if you look closely at their corporate governance, they executed significant board refreshes in 2023 and 2024.
Right, I saw that.
They brought on independent directors with heavy experience in scaling tech platforms, which aligns perfectly with their NASDAQ Q listing requirements.
Okay, so there are adults in the room.
Yes. That signals mature, active governance overseeing this capital deployment. They aren't just going to burn this $60 million on vanity projects.
But raising $60 million is the easy part, right? Deploying it without destroying shareholder value is where companies usually stumble.
Oh, Absolutely.
A war chest does not guarantee a victory. Execution is absolutely everything. So
Yeah.
let's lay out the bear case here, because protecting your portfolio means understanding exactly what could go wrong.
Right, and we see two major risks to this bullish thesis that you need to monitor constantly.
What's the first one?
The first risk is directly tied to that ATM offering we just discussed. While the market is giving them the benefit of the doubt today, that 5 to 10% dilution risk becomes very real and very painful if management fails to deploy that capital efficiently.
Right. If they just sit on it or buy a dud company.
Exactly. If that 60 million isn't directed toward high ROI acquisitions or aggressive product development that accelerates revenue growth much faster than the rate of dilution, existing shareholders are going to feel the drag on their shares.
So capital allocation over the next 12 months has to be flawless.
It has to be.
And the second major risk is the massive execution risk of the software transition itself. Like I said earlier, changing a legacy hardware company into a nimble software company is notoriously brutal.
It's a graveyard for a lot of companies.
It's like trying to change the engine of a car while you are flying down the highway at 80 miles an hour.
That's a perfect analogy.
Right. And for this entire bullish thesis to survive, Multisensor AI absolutely must achieve over 80% software gross margins, and they must maintain over 90% subscription renewal rates.
Those numbers are the critical threshold. If they fall short of that, the SaaS valuation narrative dies instantly.
And they have to hit those metrics while fending off the looming threat of much larger IoT and AI platforms.
Right. We were talking about industrial titans here.
Companies like GE Digital or Siemens with their massive MindSphere platform. These companies have bottomless pockets, armies of developers, and deeply entrenched relationships across global manufacturing. Which raises the obvious question, right? If Siemens or GE really wants to own this space, why don't they just crush Multisensor AI? What stops them from rolling out a competing predictive maintenance module and just giving it away for free to their existing clients?
Well, that is the nightmare scenario for the bear case. Right now, Multisensor AI is protected by their highly specific domain expertise. You know, that 30 years of thermal and acoustic data we talked about.
Right.
Platforms like Siemens MindSphere, they're often broad, generalist platforms. They do 1,000 things well, but maybe they don't do microvibration analysis on a specialized turbine as well as Multisensor AI does.
Okay, but if they decide they want to.
Right. If these titans decide to aggressively subsidize their predictive maintenance modules just to starve out smaller players, Multisensor AI could find themselves trapped in a race to the bottom on pricing.
And that would absolutely torch that 80% gross margin target.
Yes, it would. And Wall Street is currently analyzing them with the expectation of software-like multiples. If they start looking like they're reverting back to a lumpy, low-margin hardware business fighting a price war, the market will re-rate the stock aggressively downward.
So the execution of this software pivot is the single point of failure.
100%.
All right, so you are armed with the upside, the incredible return on investment, the sticky recurring revenue, the M&A war chest, and you are wide awake to the risks of dilution, massive competitors, and margin compression.
Right.
It is time to lay out the actual playbook for your portfolio. Based on our current market analysis and the trajectory of their Connect 2.0 platform, we are giving this a bullish score of 7.5 out of 10.
A 7.5 accurately reflects the immense scalable potential of the hardware-to-software pivot, but it's appropriately weighed against the very real execution risks of fending off those industrial titans.
And in terms of your investment horizon, we view this as a 12 to 18-month swing-to-core position.
Right. And what that strategy entails is initiating a smaller position as a swing trade based on near-term catalysts, but with the specific intention of building it into a core long-term portfolio holding as the company successfully proves out its software execution over the next year and a half.
And looking at the catalyst calendar, the next 3 months are going to be absolutely critical for proving out that thesis.
Absolutely.
We are looking very closely at late April 2026. That is when their Q1 earnings will hit the tape, and that report is going to be the ultimate lie detector test.
It really is. We need to see hard, undeniable validation of that software revenue growth.
Right. Then, moving into Q2, we are watching for guidance raises. We want to see management signaling deep confidence for the back half of the year.
Exactly. And of course, as we move through the summer, we are waiting for announcements on exactly how they are deploying that $60 million capital raise.
Right. Will it be a strategic acquisition of an IoT startup?
Oh.
Or an acceleration of their AI capabilities?
And that brings us to the optimal entry strategy. For an investor looking at the chart right now, the best move relies on patience.
Okay.
You want to look for any weakness or temporary dips following the ATM announcement as the broader market slowly digests the potential for dilution.
Or, I guess, wait for the earnings.
Right. Alternatively, the safer play is to wait for the late April earnings report and buy on a confirmed beat and raise surprise.
Meaning they exceed Wall Street's expectations and raise their future guidance.
Exactly. Paying a slightly higher premium for a stock after momentum is confirmed is often much safer than trying to catch a falling knife or guessing on an earnings coin flip.
So for the listener looking at their portfolio right now, trying to decide where to allocate capital, it sounds like this isn't a buy immediately with both hands situation to front-run the earnings.
No, not at all.
It is more of a wait and see what they do with the 60 million play.
Given the neutral market sentiment and the ongoing consolidation on the chart, it leans heavily toward wait in slowly.
Let the late April earnings validate those 80+% gross margins.
Right. Let management show their hand on capital deployment. The total addressable market here is so large, and the upside of a successful software pivot is so substantial that you do not need to capture the absolute bottom tick to generate significant wealth.
Right. You want confirmation that the engine change at 80 miles an hour is actually working before you get fully strapped into the passenger seat.
Exactly.
Okay, let's summarize the entire thesis so you have it crystal clear. Multisensor AI is a genuinely fascinating play. It takes a proven, 30-year industrial foundation built on heavy hardware and attempts to layer a modern, high-margin, predictive AI software trajectory right on top of it.
And if management executes this pivot flawlessly, they are positioning themselves to own the central nervous system of the factories of the future.
Yeah.
And they are executing this strategy in a macroeconomic environment where industrial downtime has never been more catastrophically expensive.
Wow.
The combination of their proprietary multi-sensor fusion, that critical human validation layer, and their aggressive capital positioning, it makes them a unique standout in the predictive maintenance space.
Before we wrap up, I want to leave you with a broader perspective to ponder on your own today regarding your long-term portfolio.
Yeah, this is important.
We spend so much time in the financial media obsessing over AI in the digital realm, right? We talk endlessly about chatbots writing emails, algorithms generating marketing copy, or software coding itself.
It's all anyone talks about.
And yes, there is money there. But the true untapped generational wealth might actually lie in AI that monitors the physical world,
Absolutely.
predicting the catastrophic failure of a massive industrial turbine in a power plant before it shatters, or keeping a global logistics hub running 24/7 without a single mechanical hiccup. Well, that could ultimately be far more lucrative and far more essential to the global economy than a chatbot that could write a decent poem.
That's incredibly well said.
So keep a very close eye on the calendar for those late April earnings numbers, because that is when we will see if this physical AI narrative becomes a financial reality. Thank you for joining us on Smart Wealth with Joshua, and we will see you next time.